Hi CA students, let's revise CA Final AFM Chapter 6 Portfolio Management Practical Question 37. A has portfolio having following features. The security is given, beta is given, random error which is nothing but the unsystematic risk or the residual risk is given, and the weights of the securities are also given. You are required to find out the risk of portfolio if the standard deviation of the market index is 18%. So we need to find out the total risk, which is nothing but the total variance, which includes systematic risk and unsystematic. So before solving this, we need to understand two major things. One is this assumes the Sharpe index model, wherein the risk is divided into systematic and unsystematic portion. Systematic mostly drives based on the uh, market beta, but unsystematic portion depends on the company specific information. So but Markowitz theory goes with the covariance matrix, wherein it will not consider the systematic and unsystematic portion and all. So why this is relevant? Because in the previous formulas which we have seen in many practical questions, we'll be using that a plus b the whole square approach or a plus b plus c the whole square approach for the stocks, right? Wherein we have more than two stocks and all, we'll be using that. In that, the main ideology is because of diversification, the risk of the portfolio will reduce compared to the individual risk, and those formulas will cater for all the stocks risk, and in Sharpe also it will cash for the risk of the stocks. But the main difference here is, in case of Markowitz approach, we cannot add the variance directly. That's why we are calculating in that a plus b whole square approach, right? Because the risk of the individual security and the risk of the portfolio will not be same. But in case of Sharpe model, since the risk itself is divided into systematic and unsystematic portion, the unsystematic risk will never have a covariance, which in turn you can directly add the variances of the returns in only for the unsystematic portion. And if beta is already given, the beta signifies the sensitivity of the return towards the market return. Hence, from the total risk, systematic portion will get calculated separately. So if beta is given, then we can take the weighted average of beta and then find out the systematic risk of the portfolio separately, and unsystematic portion can be directly calculated by adding the variance of the variance is nothing but the risk. So adding the unsystematic risk variance portion directly of the securities in the portfolio to get the unsystematic risk, and then adding both will give us the total variance. But in Markowitz approach, we can't do that. We have to always go with that a plus b square approach, or that which is nothing but the covariance matrix. In for our purpose, we are calling it like that. So going with this assumption, now let's see the problem. And wherever in a question they are mentioning unsystematic risk or systematic risk, that indirectly signifies that we are assuming Sharpe index model. Hence we can follow this approach of adding the variance of unsystematic risk in a portfolio. Okay, now leaving all this aside, we will go with the problem. Now they are asking the total risk, and we know that they have given unsystematic risk, so it is assuming Sharpe index model only. Okay, now as we know that the total risk consists of systematic risk and unsystematic risk, and systematic risk is nothing but beta of portfolio multiplied by the variance of market return. Now same can be found out. We know the beta of portfolio. We know the beta of individual securities, so multiplying with the weights will give us the beta of portfolio. In our case, it is 1.295. And beta of portfolio square multiplied by variance of market return, which is 18 is the standard deviation, so 18 square will give us the variance. So if you see the first solution, this 1.295 the whole square multiplied by 18 square is nothing but the systematic risk portion, beta of portfolio multiplied by the beta of portfolio square multiplied by the standard deviation, variance of market. Now the other portion is the unsystematic risk portion, which is the summation of the weight square multiplied by standard deviation, weight square multiplied by the unsystematic risk square. So for this I have clearly explained in one of the previous practical questions, which is this 34. So wherein I have clearly explained variance of a portfolio if since the systematic risk, the covariance of the unrisked the covariance of the securities will be 0 in case of the unsystematic risk portion. Hence the formula of a square plus b square stands valid. So watch this video for the detailed understanding, it will give a better idea. So it is problem 34, practical question 34. This portion will give an idea. Okay, now coming back here, hence it is 37. Yeah, so this portion we have to use this formula and we'll get the standard deviation as 23.69. Here they found out the variance. Then since the question specifically talks about the risk of the portfolio, we can take the standard deviation. 23.69 is the value. As you can see, they have did root in an indirect way, so we have to notice this properly. Half signifies root, power half. Okay, now the alternative answer is where it comes into part. As I previously told, the variance of the unsystematic portion can be added, hence the alternative answer assumes this. So if you see, it looks like we are just directly adding the variance of individual stocks and then multiplying with the weights. It looks like a weighted average method, but as I clearly told in Sharpe's index model, the unsystematic portion can be added like individual securities in a portfolios. Unsystematic portion can be added, which is nothing but the variance can be added to arrive at the total variance. Hence this assumption stands valid. As you can see, they have taken the beta square multiplied by standard deviation square to get the systematic risk. Then they are just taking unsystematic risk. For that, they have clearly given the random error rate in case of individual returns. They are just squaring it out and then adding this squared portion in the ratio given. That's what here it is done to arrive at the total variance. Then root of that variance will give us the standard deviation. So either of the ways works. That's it. Thank you.